Hello and welcome to your daily educational video here provided to you by Forex.Academy. I am of course your host Robert Blackwell and have the pleasure to walk you through today's daily education. Before we do so, please let us discuss and consult the following disclaimer. Now, there is always risk inherent when deciding to trade financial markets. And let us delve right into the content of today's education. We will be discussing limit orders. So what is a limit order? First of all, now there are two types of separate limit orders, one to enter the market and one to actually look to take profit-taking orders in the market. Limit orders can enable traders to buy or sell at specific prices they only want to enter the markets. It can help traders who focus on a definite amount of pip gains or better price execution. Okay, so if you want to perhaps buy a market at 61.50 and place a limit order to actually take profit at 62, there's 50 pips there, you know that that's your definite trade. However, you can also use a limit order to look to buy the buy the market at a certain price. So perhaps you don't think 61.50 is a good price to buy that market at. You can use a limit order to actually look to buy that price. If the market retraces below and perhaps execute that market at market price at $60 for the particular market. Limit orders can also allow the trader to outline a predefined profit target. Okay, profit can be captured when the trader is not actively trading. So when you're entering these markets, of course, whether it's market execution or a limit order, you can set a profit-taking limit order, move away from your trade screens, given that you have your analysis and you believe the market is going to move to such a level, and look to actually capture those profits whilst not actively trading. Profit limit orders do pertain a focus on limiting profit. We often discuss this as a shortfall to running winners, and obviously trying to run your winners and cut your losers short is a skill in itself. A limit order here, so we have an example, is like a stop order, except it establishes a predefined exit for profit. So let's say we enter a market, the market moves with us, we buy perhaps 10,000 euro or a 0.10 lot of euro dollar at 124. We can then place a limit order for 100 pips, so say 125, the difference being the 100 pips within that market movement. If the market trades up, we have a potential profit of $100 on the trade, and we simply calculate that by our exposure to the trade size with the market that we are trading. So as you see, we can use this as an example with the limit order to actually define a predefined exit for profit. Now let us discuss entering the market in much more detail. So we can use different order types to actually enter the market. Here we can enter the market on the long side. Of course, we can decide to trade more actively and trade at market execution. We can choose to use a buy stop, and that is looking for when markets push through a certain price, then we enter the trade. So technical traders often do this. But what about value traders, or traders who assess the market and say, well, the market is going to pull back and then move off in one particular direction? We can use limit orders for this. So here we have an example of entering the market on the long side, okay, and we can use buy limit orders. So again, the order types can allow us to take the same positions in the market but at different prices, and as a result, varied consequences. A buy stop, the order is placed above the price and the price keeps going up until we reach our target. We execute the market price and we are now long that market. The buy limit is, of course, when we decide to trade a market or place an order on the long side, but actually below the market price. So we're hoping that the market retraces and then executes our order so we can go long. So we place our order below price, the price moves down and then goes up, we execute that trade. We can also use limit orders to trade on the short side. So let me discuss that in detail. We can use, of course, different orders. Sell stop is a very very proficient order to actually look to enter the markets when there's momentum. So if we think about a market that is trading to the downside, showing this momentum, continuing to trade down, let's use the oil market as an example, where oil is trading at $60 per barrel. It now trades at 59.50, and when it hits 59, we want to sell that market for a long-term trade to the downside. We can use a sell stop for that. So we place our order at 59, and as the market trades down and down with a lot of momentum, we'll then execute the market as a technical analyst. There we can use that proficiently. Okay. In a completely different contrast, we can then use limit orders again on the short side. So what we look to do is we think perhaps the market is overpriced and we're hoping that it bounces off an upper level and we want best execution at that price. So let's say with the oil example again, um, the the unfair value price or the top price in the oil market that we see is $65. The oil market then moves up. We can place our sell limit order at 60, perhaps 64.90. We get the trade when the market trades up to that and reverses from that. Then we actually get our execution to the short side at a better price, a much higher price, and obviously we're selling the market hoping the market moves to the downside. So you can see a very strong, very difference between using stop orders and limit orders. Stop orders must break through the price in order to execute the positions, whilst limit orders must anticipate retracement in order for execution. Okay, so a very simple example is how we look to enter these markets, how we look to use different order types to proficiently affect our technical analysis, whether we're looking to follow that momentum or whether we think a market is overvalued. We want to certainly buy the market, but at a much lower price. Well, we can place our buy limit orders at those prices where the market is much higher, only for the market to trade down. We only want to buy the market at a certain price defined by ourselves as traders. Of course, if the market continues to move up and continues to trend in a certain direction, we may completely miss the trade, and that is one disadvantage to using this type of order. But again, a severe advantage to using it is much better price execution that is defined by ourselves in terms of our own trading strategy or ideas. So that concludes this short webinar, giving you some insight into how to trade both stop and limit orders. Thank you very much for joining us here at Forex Academy. We'll see you next time. Bye for now.